Good morning, everyone, and thanks for joining us. Welcome, everyone, to PwC Nigeria's Financial Services Roundtable discussion. We would be kicking off just with the initial introductions, and hopefully as more people join us, we would have a full class before the first speaker is over. So I would like to welcome you all to this discussion today. It gives me great pleasure to bring our financial service focus, FS Focus, to you. FS Focus is PwC Financial Services thought leadership publication, where we aim to bring to the industry topical issues that are affecting the FS industry, and we hope you all got access to the online publication and that you enjoyed going through that. We would be looking specifically at two of the articles of publication, and just to kick off immediately, my name is Chioma Obaru. I'm a financial services partner in Assurance PwC Nigeria, and I'm also the editor-in-chief for the FS Focus. And with me today, Kenneth Erikume. Kenneth is the moderator and would be taking the questions and answers section of the discussion. So today we'll be looking at two topics, and would have three speakers addressing these two topics. The first one from Dr. Andrew Nevin would be on COVID-19 and its continued impact on Nigerian banks and insurance companies. Andrew will be speaking generally around the global and national impact of COVID-19 so far. Bolanle would then take over. Bolanle Adekoya is a partner in our assurance services and also the head of our capital markets and accounting consulting services unit. Bolanle will take over to talk more in depth around the application and the reporting impacts of COVID-19 as we've seen it recently. We believe this is a topical discussion as most audits are ongoing, and we hope you find it enlightening. Immediately after Bolanle, Timothy would talk about the tax function imperatives for CFOs post-COVID-19, and then we'll have the Q&A, questions and answers. I would like to appeal that questions are left for the end of the session, where we'll take all the questions. So if you have any questions, do drop it in the comment box, and we'll take all the questions immediately after the last speaker is done. So without further ado, I would like to introduce you to the three speakers here. Andrew Nevin, partner and chief economist; Bolanle Adekoya, partner and head of our capital markets and accounting consulting services; and Timothy Siloma, associate director in our tax unit. I would like to hand over to Andrew now to have the first session.
Thank you so much, Chioma, and thank you to all our wonderful FS clients and friends that have joined us this morning. We really appreciate your presence. I'm going to speak for perhaps the next 20-25 minutes on issues from a kind of economic and FS perspective that need to be on all of our minds. But before beginning, I think we can all reflect on the COVID-19 journey and the challenges we faced over really almost a year now, with both the health and the economic issues that this has raised. And please, let's all say a prayer for those of us who we've lost over the last year. And of course, we're still not out of COVID-19. This is not a seminar on sort of exiting COVID-19. If you look on a global basis, we have more deaths today, I believe, than any other day in COVID-19. Certainly in the UK, they reached a record number of deaths yesterday. The US has passed 400,000 deaths. And there remain many, many difficult countries, including the challenges that we face in Nigeria. So please, this is not over. So we wanted to share with you this morning things that we think we need to keep in mind as we're coming, and I'm not saying coming out of COVID, but as we continue to deal with COVID, because COVID takes so much attention and of course the ways we've changed working, that sometimes we forget some of the other issues. So today we wanted to kind of bring those issues back to the back in focus for our clients. Sorry, I'm just seeing if I can move the slides, if I have control of the slides, Adam or Linda. So what we wanted to discuss in my time on this is just 5 issues that we think are important as we move through and eventually exit COVID, we hope. So the first thing I'm going to talk about is really, at the end of the day, after a year, the economic challenges that Nigeria has are the same as the ones we went into COVID-19 with. And so we need to keep focused on being able to address them. I'll say a few words on the role of the FS industry, not just as a passive observer to the Nigerian economy, but as someone, as a group who kind of have an active role to shape the Nigerian economy. I'll say a couple of words just on AFCFTA, which already you can see is having a major impact on the way financial services are done across the continent. I won't name any particular clients in this sort of setting or specific FS companies, but there was one, I believe, yesterday that had a major conference with its investors and discussed the opportunities from AFCFTA, which is really a positive. We do want to mention, I guess in 2 places, something that is very critical for the industry, which is around sustainable financing and sustainable development. Then we also want to touch briefly on demographics and some of the implications for the industry. And I'm going to close my section, which I'm not sure why it says 4, it's 5, but on climate change, because we really think for the entire industry, this is such a critical issue, and we want to keep in the frame of everyone. So please, if I can move the slides. No, next slide, please. Oh, did I move that? Okay. So many of you might have seen, how we think about the economy in Nigeria. These are 7 themes that we've been discussing for the last year. And we think that these themes remain critical on there. So I didn't bring a slide for every one of the themes, but a few slides we brought, but which I'll show in a moment. But the ones we didn't bring a slide for, so example, large informal sector. It's really critical for the industry to grow, both for its own growth and for the growth of the Nigerian economy, to bring the informal sector into the formal economy. So that means banking the unbanked, bringing in microinsurance, bringing in micro pensions. I mean, there's obviously been a huge effort by SANF and many of the banks to bring agency banking across the country, including in areas that are traditionally not very well served. We would like to see that focus continue and be accelerated. Disparate growth at the subnational level. On this issue, we've been saying for some time, and it's really critical for the FS industry, that Nigeria's success depends on poles of prosperity, many poles of sustainable development. We need things to happen in Calabar, we need them across river, we need them in Abia, we need them in Sokoto. I had a chance to interact the other day with the governor of Bauchi State. Very impressive how he's thinking about the development of his economy. And so many governors are really focused on doing what they can at their state level. And that's critical for the whole FS industry, because sometimes I think we all tend to be too kind of Lagos Abuja focused, and the FS industry needs to make sure it's serving the whole country, both for national development, but also so the FS industry itself can boom. Shrinking public funds and low taxes. I think we're all aware of the numbers of the deficit that we have right now. The way we've expressed it is, we have a real strain with the social compact. I mean, people have not wanted to, the government hasn't been, traditionally, if you go back 6 or 7 years, wasn't asking for taxes and wasn't supplying services. People supplied their own infrastructure, security, power, education, health, for example. Unfortunately, that social contract has run its course. It's no longer fit for purpose. And we're in a new era where we have these incredible budget deficits, and yet very difficult when the economy is not growing to be able to raise taxes or to bring more people into the informal sector. The other points, I have a slide on each one, so let's go to the next slide. See if I can change it, or Linda's changing it. This is a reminder of the fundamental issue that faces the Nigerian economy. So when you read the press or listen to the press and you hear announcements from the federal government on this program or that program, I mean, I'm sure many of those are helpful. But at a fundamental level, we have had growth, GDP growth in Nigeria that's below population growth in 2015, 2016, 2017, 2018, 2019. Certainly 2020 was a very difficult year, as we all know, and almost certainly we're going to have growth below population in 2021. In fact, the Central Bank of Nigeria has pegged it at 2%. In terms of population growth, I was a bit surprised. I've always thought it was 2.7 or 2.8%, but the chairman of the National Population Council told me that it was 3.2%. So if we grow at 2% GDP, headline GDP, and population grows at 3.2% in 2021, and further erosion of GDP per capita. Now, why is this happening? On this graph, we just show the what the economists call gross fixed capital formation as a percentage of GDP for 3 countries, really China, Nigeria, and India. Of course, Nigeria is going to soon be the 3rd most populous nation in the world, so these are the 3 most populous countries. And there's a relationship between headline GDP growth and investment. At the end of the day, it is not possible to get headline GDP growth without sufficient investment. And on this graph, you see for the last number of years, the red line in Nigeria, excuse me, that we are about 16 or 17%. The target that we would like to see is the yellow line, which is India. So India has invested roughly 26 to 29%. And they have got growth of 6 to 8% in GDP terms, and hundreds of millions of people have been lifted out of poverty. We will continue to have declining GDP per capita unless people invest in Nigeria. So this includes Nigerians, the diaspora, people outside of Nigeria, and the fundamental challenge for the country is, why are people not investing in Nigeria? And this is an issue that is of great interest to the FS community, because you want the GDP to grow, but also, as I said, you play a big role in helping to create the conditions for this growth. Next slide, please. We put out the paper last year that talked about dead capital and real estate. Again, we put this as perhaps, with the low investment rates, as the biggest single economic issue facing the country and central to the FS industry. We basically said that what was, where we had to start from an economic viewpoint is unlocking dead capital, or turning dead capital to live capital. So dead capital are assets that the country has that are not productive or not producing return for the country. The largest amount of this is in real estate, but there are also assets, of course, like Ajaokuta Steel or the National Stadium, for example, which are draining the federal treasury and not producing a return. So the number one urgent task is to unlock this dead capital. This numbers that you see on this slide express it in kind of residential real estate terms. There's no success for the country unless we unlock this dead capital and unlock real estate. And of course, the FS industry is at the center of all of this. We need to build a mortgage market. Of course, there are all the things that need to be added to as part of this, including some changes to the Land Use Act, and registration, land registration, and some of the very practical issues that are preventing it. I know this is very personal to me. I did have a mortgage in Nigeria, one of the 50,000. I did manage to pay it off, but it really is difficult to get a mortgage and to register property. Unless this is solved, we're going to continue to have sub-population growth in GDP. Next slide, please. The Diaspora, again, we wrote the paper last year that didn't introduce any new research, but just highlighted just the criticality of the remittance business for Nigeria. This continues to be central. The World Bank put out a report that said 1 out of 2 Nigerian people are touched by remittances in some way. And at the end of the day, it has a much bigger impact on the country than oil. And the term that we're now using is Nigeria's biggest export is brains, not oil. And we encourage that. We think exporting brains is the right strategy for Nigeria. But we, of course, don't necessarily have to export people to export brains. There's more and more ways to export Nigerian brains and earn FX without exporting people on that. But this, and in fact, I was on this call this morning with Amal Hassan, who many of you may know. She's the extraordinary leader of Outsource Global, which has over 1,000 seats in Kaduna and Abuja, and I think soon Maiduguri, where she is hiring Nigerian university graduates to do BPO type tasks in those places and earning FX. But this flow, sorry, there's some noise, background noise. This flow for Nigeria is critical. Is critical, and
the voice note you sent, I can't hear anything. Nothing is.
This flow for.
I for your sign control.
Linda. This flow of diaspora remittances for Nigeria is absolutely critical, and we need to make sure the FS industry is doing everything in its power to be able to maximize the value of the flow to Nigeria, including new products, ways for the diaspora to invest in Nigeria. So Linda, can you mute, please? Okay, so then we also, another trend that, sorry, Linda.
I'm here.
Can you mute? So another trend that's critical for Nigeria is the movement to think about the economy not just in GDP terms, which is our traditional way, but more and more we're now thinking about the economy in terms of the Sustainable Development Goals. And everyone on the session today, your FS institutions need to be thinking about how what you do intersects with the Sustainable Development Goals, because they are rapidly becoming a language and a way that we're thinking about what's happening in the economy and society. I'd like to highlight in Nigeria now, there's now the Financial Center for Sustainability Lagos, which is a private sector initiative started by FMDQ, one of our most important FS institutions on that. They're really trying to drive in many, many ways across many of these sustainable development goals, developments in Nigeria. And I think it's fair to say that no FS institution can go through this year without becoming very conversant with this and starting to build the sustainable development goal thinking into their decision making. There's a lot of reporting that's now coming on that. We help a number of organizations with reporting around sustainable development goals. So we're very happy to talk to you further about that. Next slide, please. So I promised to talk briefly about demographics. I just want to remind everyone that we in Lagos and Nigeria are really at the center of the world. I love this particular chart. Anyone that wants to use it for their presentations, I'm happy to supply it. You can find it easily on the internet. But we tend to forget how physically big Africa is. So, you can see on this chart kind of all the other 97% of the world's economy fitting into Africa. We've just gone through 4 or 5 years of being consumed with Brexit, and yet Great Britain fits into Madagascar. Next slide, please. Now, in demographic terms, what's happening in the world right now is that there is a massive tilt, which I think people are really going to understand in 2021 and talk about more and more, to Africa. Basically, in the rest of the world, the number of adults, of working age adults, and the number of children has essentially peaked outside of Africa. So you may think the world's population is going up rapidly. That's not really the case. Country after country, you have shrinking populations, and even where the population continues to rise, the number of children and the number of working age adults has peaked or declining. And you can see here exactly why this is happening. I mean, this is done in 5-year increments. The total number of children born in India, the number of children born in this 5-year increment versus in a decade versus in 2 decades is declining rapidly. In China, you can see how rapidly the number of births is declining. In Indonesia, it's declining. Russia, Germany, United Kingdom, very, very small. And of course, this is why Nigeria is projected to become the 3rd or perhaps the 2nd most populous country in the world by the end of the century, and also why Africa is all of a sudden, it's not all of a sudden, but people are starting to recognize just the centrality of Africa to this. Now, for the FS institutions, and this is related to AFC-FTA, there's just tremendous opportunity just in the home market in Nigeria, but also outside within the broader Africa. And I've been talking to a few global FS institutions, and I have to say, I don't think they're competitive in Africa. I think the people that are going to control the African FS market are African FS companies, and particularly ones led out of Nigeria. When you look across the board at some of our banks and some of our insurance companies, it's really exciting to see what they've done on the continent, and also now what they're doing, planning to do with AFC-FTA. So the way I look at it, and people ask me why I'm in Nigeria so long, for more than a decade. To me, in Lagos as my home, Nigeria is my home, I really feel like I'm kind of in the center of the world. Thank you. For the next slide, please. I've got the slide, sorry, go back one slide. Just before we come to this slide, the top cities. This is very interesting. I mentioned before that there's a new projection that shows Nigeria will be the 2nd most populous country in the world by 2100. So this was done about 6 months ago by Lancet, the very reputable UK medical journal. And you can see under this chart that Nigeria by 2100 will surpass China as the 2nd most populous. So truly extraordinary. But that also means tremendous pressure on what happens to the economy and society and the FS industry. If Nigeria is going to be successful and prosperous, the FS industry is at the heart of it. Next slide, please. And finally, just on the demographics, wrap up with just a reminder to everyone that actually Lagos is projected to be the world's most populous city by the end of the century. As I just mentioned, I feel like I'm center of the world on it right now. So let's not forget, we really are kind of the heart of the future of the world. Next slide, please. So go back that one. There we go. Okay, so I promised the last thing I would discuss is climate change. We feel at PwC globally and within Nigeria, this is such a critical issue for the world and for the country, and also for the FS industry. I mentioned before a little bit about the Sustainable Development Goals, specifically the climate issue. Every FS organization needs to be, as we come, we hope, to the end of COVID, very focused on this. This chart just shows something. I know it's a little bit complicated. On the left-hand side are a number of indicators about the human world, so GDP, energy use, tourism. And on the right-hand side are the blue graphs are a number of things about the natural world, so ocean acidification, tropical forest loss, fish capture. And you can see that about 1950, for many of these things, there was an inflection point, an acceleration of both the human activity, population, economic footprint, but also impact on the natural world. And of course, up until recently, we never really thought of people having much impact on the world, but that is not the case, sadly, as we see now. Next slide, please. And of course, this is manifesting itself in all sorts of ways. We're seeing extreme events around the world. This particular slide, the world's highest recorded temperature recorded by humans, hitting almost 55 degrees Celsius in the United States. The next slide, we're seeing rapid melting. I'm Canadian, as everyone knows, Canadian originally, rapidly melting ice around the world, threatening the habitat in the northern climates of many species, polar bears, here the huskies. And next slide shows something that is particularly worrying, I think, for all of us, and that's why we brought it today. This is one projection of the percentage of population that would be underwater in different countries with a 2 degree Celsius rise in temperature, just 2 degrees. And you can see, if you look carefully, that Nigeria is the light blue, which means that 10 to 25% of the population would be underwater at 2 degree Celsius. So this is not an issue that's out there for the rest of the world. This is climate change is an urgent issue for Nigeria, and it's an urgent issue for the financial industry, because financial services industry, because the financial services industry are the people directing money, resources, what they're doing, and this has to be at the forefront of that thinking. Next slide, please. So just as I come to the end of my part, I mean, we are in very difficult times, and it's going to require the whole industry and the whole country and the whole world to come together to get through this. We may be coming to the beginning of the end, at least in COVID-19, with the vaccination. We face, though, tremendous economic fallout, as we all know, globally for the next few years. But right behind that is the impact of climate change on that. So, we just want to be kind of very direct with all of our clients and friends and how challenging the next decade is going to be. So just for me to wrap up, we can, as the economist puts it, you can choose to look the other way, but we can never say we did not know. We wanted to bring you this morning some really this serious issues as we come through COVID-19. We've hopefully given you something to think about this morning. I'd like to turn it over now to my wonderful colleague, Belanley, who's going to talk about the complex issues around the accounting for COVID-19 as we come through this. And these are all difficult things that every client needs to deal with. So please, Belanley.
Thank you. Thank you, Andrew, and a lot of food for thought there. Good morning, everyone, once again, and welcome to our Financial Services Roundtable. I'll be sort of taking us through some of the key financial reporting and accounting issues, some of which we discussed in the publication to sort of help us plan. One of the things that a lot of people like yourselves need to understand is that the effect of COVID, even though, maybe on the health side, you have a sort of 2-year type span with wave 1, wave 2, and likely wave 3, the impact on businesses and the economy goes a lot further than that. And for us in West Africa, especially Nigeria, the financial services sector is a very, very important part of it, because you are, one of the people that sort of fund certain things, and a lot of people come to you for capital because of the fact that our capital market is still growing. We're not sort of there yet, and it's important that you are able to plan ahead for it, to be able to do business, to be able to deal with those who need the funding, and also to be able to manage the effect on your books going forward. Next slide, please. So I'm going to be running through some key next slide, please. I'm going to go through some key areas, more like reminders. So the first thing I'm going to do is sort of talk a little bit around the impairment, whether the impairment of non-financial assets and the impairment of financial assets. The truth about it is that, when it comes to something like COVID is what we call a trigger of impairment, and it will have that lasting effect on both the non-financial and the financial assets, whether you are a financial services company as a bank, or whether you're an insurance company that needs to be looking at projecting the reserve that you need to look at. And with COVID is an unusual sort of situation for everyone. So here are the reminders. Here are the reminders. So let's go to the next slide, please. Okay, so from the non-financial side, when you look at your non-financial side, a lot of it is sort of looking and thinking about your your customers. What are happening, what's happening to them? A lot of them have a lot of their businesses are struggling at the moment when it comes to sort of the projection. Cash flow is uncertain. Yes, certain industries like healthcare might be doing well, but the fact is that if they, on their side, when you look at their value in use versus fair value, so a lot of them are, whether of the value in use. So value in use is looking at their business and cash flow projections. There's a lot of uncertainty around that because their businesses are not, the cycle of movement is not as, it's not as good. Maybe healthcare, they're seeing sort of some increase, but even with that, there's issues. Then there's the fair value side of it as well for them. So when you're looking at this, when you look at impairment of non-financial assets, the standard, IFRS, so that's IAS 36 says that you take an impairment, when, if you're carrying amounts or how you're carrying things in your balance sheets, if they're higher than the value in use or the fair value. So what are the things you need to look out for? Down in the market, we can see that there is, so there's issues. Inflation is at its high, even though we're looking at the government rates, they're low. However, inflation is high. So even if you have things around your, valuing some of your property, valuing your subsidiaries, all these things are going to be affected. So at the end of your December, you are December year end, you're all December year end, you would expect to see some of these impairment charges in your books already because the quality of earnings have gone down. And how are you taking effect of it? What interest rate are you going to use to discount those cash flows? I know a lot of people are not happy. I've had a lot of discussion with clients who are complaining the fact that, the government risk-free rate has dropped significantly, but inflation is very high. So what rate do you use to discount your cash flow? So these things are the things that you need to look at as well. And then what assumptions are you going to use? So some of you may have foreign bonds. A lot of these foreign stakeholders would expect to see some of these hits in your books, whether it's from your subsidiaries, from your properties, anything they're holding, investment property, they would expect to see this in there. And what about your budget and your forecast? How realistic are they? Because as we said earlier on, even though on the health side, you might find a 2-year window with regards to COVID, with what health experts are saying, the long-lasting effects are still there with regards to your assets. Another area that you mustn't forget is that some of you may have done transactions around business combinations, which would have allowed for, you'd have been carrying goodwill. Most of your goodwill is probably impaired now because a lot of the assets or subsidiaries that you may have that may have been attributable to this goodwill are all having issues. So you have to take that hit, and that would hit your profit or loss. So once that hits your profit or loss, unfortunately, goodwill, you cannot reverse it, because I know some people will say that it's that these things are temporary, but how do you deal with all these things, you need to have them in mind, even your things like as your segment reporting, when you're doing some of your segment reporting, how are you taking effect on the different areas that COVID will have on you on the side of impairment of non-financial assets as well. So you need to be able to tell that story in advance. Next slide, please. So on this side, so what are the things that you need to look at? So earlier on, I talked about the non-financial assets. Well, the biggest area for most of you are your financial assets. And the reason for that, of course, is because they make up a big part of your balance sheet. So when it comes to the impairment of financial assets, as we all know, for those of you who are carrying debt securities, you have some of you are carrying loan receivables and certain reserves. We are looking at expected credit loss in accordance to IFRS 9. And what does that entail? This assumes that you're going to have to, make forecasts. You're going to look at some of your macroeconomic factors. A lot of these macroeconomic factors are already having issues. We have economic forecasts where we're finding it difficult to even predict what is going to happen. So when it comes to the scenario analysis, IFRS sort of says to you, when you look at the IFRS 9, you're supposed to look at how look at the various scenarios. So what would be your best case scenario? What would be the downturn scenario? Or what would be the the mid case scenario as well? So what percentage or what weighting would you give that to? A lot of people, they know that with the weighting at the moment, in previous years, people may have given maybe 50% to best case and 30% to maybe worst case, another 20% in mid case, or vice versa, depending on the industry you're looking at. Well, how do you then determine it? Which is one of the reasons why we're always saying to everyone that you need to do constant reassessment, reevaluation, even recalibrating some of your assumptions on a quarterly basis as well. Previously, people will tell you at least annually or at each reporting period. But we have a situation where liquidity is becoming a problem. Credit risk is very high. If you notice that some of your you've had to extend a lot of moratorium, cash flow is very restricted because people are having to people are coasting, people are holding on to cash at the moment because there's so much uncertainty on where investments will go on. And there's been a lot of plans. You have a lot of your companies, clients who may have been in the construction sector, for example, construction, or people who have long-term infrastructure projects who have projected that they will start seeing returns in 2 to 3 years. What do you do with that? So you have to look at things. You look at it on a sector basis. You have to look at it based on the credit risk for each sector, based on credit risk for each counterparty. So there's a lot of information that you need to do that, and you must have supportable information for this. As I said, one of the challenges that we have is because we're having issues with actually predicting it because we've never had COVID before. So in previous years, what people used to look at, you look at the last 10 years, last 12 years, and be able to make projections of what you see, how economic recovery will be. But at the moment, a lot of people are not sure about it. And so because of that, you will need to get, some of your credit risk analysts, your quant expert actuaries involved, and something that we even as PwC can also help you look at it. But but it's something that you need to look at. In addition to that, a lot of you, for those of you who are reporting on IFRS 9, you will know when it comes to staging with regards to your stage 1 loans, stage 2 loans, stage 3 loans. A lot of stage 1 loans, even though you may have looked at qualitative aspect and sort of say, look, these are businesses that will eventually do well and there's just a temporary pause. There is an indication of significant increase in credit risk. And so with that, how do you then assess it? A lot of people in previous years would either have used their probability default model or they might have used some of your internal ratings. How do these internal ratings still, does it still hold bear based on what is going on? So you will need to even look at your internal processes on how you even give out loans, or even how you look at some of these staging for some of these companies and counterparties. So it's something that you will also need to, look at. Another key area that we also need to look at is, when would you say that, for example, a loan that you may have given out has reached the stage of either the fact that it's a modification of a loan or a direct acquisition of a loan, based on some of the facts and circumstances that you have, based on some of the government support and measurements that we have. I'm going to talk about that slightly later on. But it's important that, you know, we make this assessment and get everyone involved, because, you know, from your relationship managers to those who are in credit, to those who are in financial control, you know, and even from the side of the insurers, you would have found that there have been a lot of insurance claims of late, you know, for different things, with things like loss of income, looking at life insurance policies. But there are other things as well, you know, looking at things around climate change. How is that affecting some businesses? And how are you measuring for the risk? Or even when you calculate some of your projections and your risk reserves, how are you, you know, making the projections to make sure that you have enough to cover your future claims, you know, based on your unearned, you know, your earned and your unearned premiums. Next slide, please. Okay. So the other areas that, you know, that I wanted to sort of mention once we move to the next slide is when it comes to looking at some of the, you know, your sectors, the different sectors, when it comes to significant increase in credit risk. Now, not everyone is split by sector. People look at their, you know, they group their counterparties, but within those, within your grouping for things like when you're assessing your significant credit risk based on your current processes, there you might find that you might actually have subgroups when it comes to things like your borrower sector, you know, or even from an insurance side of things, when it comes to your exposure on industries, what is going to happen with industry. So at the moment, when you look at things around the oil and gas sector, we know that there's a clear issue there, not just from the COVID disruption around production. There are other world economic issues which we don't have control over, whether it's even crude oil prices or even the demand and supply in that sense. The other thing that you also find is that there's a lot of initiatives that push for a greener, people are moving to more greener effects. And as Nigeria, we need to prepare for that. A lot of reliance currently has been around the oil and gas sector with regards to our exports, and a lot of you know, easy cash that sometimes come from that. But what happens when all of a sudden, 2 years, 3 years down the line, the world goes electrical cars? What happens down the line where people are looking at more, you know, refined gas measures? What happens in that? So these are things that we cannot go to sleep about. We need to look at it and just, you know, and look at what that would mean for us as the financial services. So you need to also start thinking about products that you may want to look at as well. So, you know, we talked about the staging and the assessment of significant increase in credit risk, which you will need to do anyway. But what, you know, there are other things that you need to look at further on as well. When we look at our FMCG group, depending of course on the nature of the product, you know, there's an impact there. Hospitality and tourism, and we know that there's been a significant hit with regards to hospitality, the airlines, and tourism all around. So when there are all these projects going on, what are the effects on, what are the effects that's happening as well? But then technology, with the increase in remote working, and the fact that, of course, people are looking at new ways of doing business, and the fact now that the world's a global platform, so people are not limited by space anymore. So these are the sort of things that you need to look at when you're looking at the various products, as well as your increase, you know, the impact on credit risk. Next slide, please. Okay, so a few things. I think I'd already mentioned this with regards to some of the management considerations for expected credit loss. So I'll just sort of reiterate it. We already said, you know, you need to look at your assets as well, things around collateral, whether, you know, the collateral that you have to be able to be, is it enough sufficient buffer for you? I know that there's been a lot of push by the CBN, for example, with regards to borrowings and CRR, and sort of trying to sort of help increase liquidity in the market. But then how do you balance that liquidity and the effect of you know, the increase in credit risk as well? So those are the type of things that you need to look at. And even with those collateral, their valuation is also affected by other parts of COVID, which I mentioned when I was talking about the non-financial assets. But you will need to look at it. You will need to look at both qualitative and quantitative measures to be able to look at your expected credit loss model. You will need to, of course, as I said, you know, not just on that, you also need to look at your budget internally. So if, for example, the performance of the organization is based on the performance of some of these products. How does that work with your budget? How does that work with your spending? These are all these things that you need to look at. So even things like staff bonuses, employee share trust schemes, all these things all will have an effect. Then even some of your processes and governance around your expected credit loss model you would have done earlier on without thinking of COVID. This is the time to start revising these things, because the fact is that COVID was just a wake-up call. There are other things that I think were on the tipping edge for us as a nation as well. So these things, we need to look at it. And the fact is that the regulators are also looking at it, and it's something that you as financial services company need to start thinking about earlier rather than later as well. Next slide, please. Okay. So credit loss estimation. So one of the things that we're just sort of that we had mentioned in the publication, which we want to just highlight here, is the fact that a lot of times you would find that organizations can be quite static when it comes to the calculation of the expected credit loss model. And this is not a time to be static, because if you're static, you might find that you're either accelerating impairments too quickly, or you are, you're slowly recording them. It can be either one or the other. So it's important that you have a process in place, whether it's on a monthly basis, to look at the different overlays that you may need to apply as a result of COVID-19 on your expected credit loss model. This can be both quantitative and this can be qualitative. The qualitative processes that you had originally put forward when you did IFRS 9 may not be relevant anymore. You might need to expand it more, especially given the industries. Now, it's not an opportunity for you to deny the fact. I know some entities might just think, look, we just need to survive, and because of that, let's just go to sleep, or we need to survive, and you're trying to be tentative about it or be extremely conservative about it. So it's important that you do look at those scenarios and look at those weighted scenarios and how that would work for your business. You might find that in some cases, geography may be an issue. There are some financial institutions that sort of have a concentration in certain parts of the country. There might be some that have a concentration in certain sectors. You will need to look at it. So for example, if you're overly exposed to the government sector, you're overly exposed to the oil and gas sector, or you're overly exposed to the FMCG sectors, those type of things, you will need to look at it. Earlier on, I talked about PD, probability of default, versus sort of looking at some of your internal credit ratings. A lot of these things you will need to assess and to find out whether there's still fit for purpose for you as an organization to allow you to make the right decisions and be able to focus on certain products as well. And then of course the last point on here has to do with collateral valuation, which I already mentioned, that a lot of the calculations with regards to the expected cash flows for you may not be there because of the fact that even on the collateral side, property or shares, may actually not have those type of values that they originally had. And so the type of haircuts that you need to take will be a lot more. Now, the last thing we want to sort of talk about a little bit about on the expected credit loss model is the impact of government intervention. So government intervention, we know that the CBN had last year sort of talked about some of the intervention loans that they had by reducing the interest rate from 9% to 5% and extending a one-year moratorium. Now, some institutions might look at this and say, in a sense, is this a market rate that needs to be accounted for as a modification, or is this a derecognition? The truth about it is that not one size fits all. You still need to do the assessments. There are three different levels of assessment that you need to look at. The first assessment is to look at the counterparties themselves, or the group or the portfolio that you're looking at, and whether this is an increase in significant credit risk for some of these individuals, especially if they cannot meet those obligations, which means that you will move them from stage 1 to stage 2 or stage 2 to stage 3, which in a sense would also affect the way you record your interest income on some of these items. In addition, of course, it's a reduction in interest income for you as institutions, for those of you who are into banking and lending. So what then happens in that sense? There is, of course, the 10% threshold that sort of gives a guidance in IFRS, in the ISB standards, about if the original cash versus the new cash flows, if there's a difference of 10%, this will be seen as a recognition, which you then, of course, need to take straight to your which you, of course, need to derecognize and then re-recognize a new instrument altogether, which can be a hassle because, in a sense, you have to sort of start afresh and putting these things on the system. Of course, if you find that the difference is 10% or under, you will just take the difference to your profit or loss financial statements as well. The other things that you, of course, need to look at when you're looking at on the quantitative side as well is to just make sure that are you still being compensated for the risks that you're being exposed to on these accounts, on these loans that you may have, and what does that mean for you as well? So it's something that you will need to look at. It's not just a one size fits all. It's something that you need to actually do the assessment for and decide how you do that going forward. Of course, if there are new fresh loans with this new government rates, these are new, and they may qualify as market rate loans because that's what's out there and that's what the government is expecting. So you don't need to do certain adjustments around government grants in that sense. But if you as the organization or as the financial institution is carrying the credit risk, in some cases that difference may also be seen as a government grant. So you will need to do this assessment and just make sure that this is being done properly. Next slide, please. Okay, so this is what I talked about. I said about the quantitative and the qualitative assessment, and as I said, if it's just a modification using the 10% rule, you put the adjustment to your profit or loss. If it is a substantial modification, we need to completely derecognize the instrument and do a fresh new one based on the new terms. Next slide, please. Okay, so one of the things that we may not, I think a lot of people are sort of a bit skeptical or a bit unsure about is terms of going concern. Now, with COVID around, a lot of people know that some of the effects might be temporary, but some of the effects may be longer term, where some people's businesses are going. Even certain subsidiaries that you may have may not necessarily be doing well, or certain divisions may not be doing well. So because of this, it's so important that we reassess and look at your going concern criteria. And you might have situations where you might need to look at and consider some of the disclosures that you may have for some of your subsidiaries as well, or even looking at some of your customers as well, and sort of say, are people, will they still be here in 12 months? And it's 12 months from reporting date. What will happen? At the moment, we're in wave 2. We heard Dr. Andrew Nevin talk earlier on about some of the issues that are being faced. So based on what is going on, what does that mean for you? So it's something that you may need to look at and sort of decide whether some entities may need to be prepared on a breakup basis, or whether you can just isolate the sort of the impact of COVID. But we need to be realistic about it. So going concern, you need to look at it, and even when you're doing your impairment assessment, some of these things would have come up with regards to whether going concern disclosure, will still be viable for certain entities. Next slide, please. Okay, so a few of the things I've mentioned earlier on, but there are other considerations that we need to look at. So there are a number of things that COVID has pushed us to do. So there have been some organizations that unfortunately have had to, you've had to restructure your organization. Maybe you've had to let some people go, you've had to change working hours. For some people, you have to reduce pay. You have to have some contingent, sort of liabilities because of the fact that you've had to pull out of certain contracts. Some of the share-based payments that you may have had. There are a lot of things that you'd be surprised that has been affected as a result of COVID. Even things as, as little as some of the covenants that some of you who may have foreign debt listings that you may have had, and you may have breached certain covenant that you didn't realize that, or thresholds, because of the way COVID has sort of hit the whole world. So what impact would that have, and how would that affect your books? These are assessments that hopefully you have already done and you've looked at. Even things that like leasing, leasing of certain assets. What does that mean to you? So amendments, there's a COVID-19 amendment in IFRS 16 for those of you who are lessees. What does that mean to you on there? Looking at your cash flows, looking at sensitivity analysis around some of these assets. As we mentioned earlier on, for those of you who are in the insurance sector, for example, your reserves. So a lot of you would have calculated your reserves based on historical, maybe your 10 years is historical amount to make sure that you have enough reserves to be able to meet your ongoing obligation and your liabilities as they fall due. But as a result of COVID, does that mean that you can just isolate the data and just do the calculation, or do you project going forward? What would that happen? We don't know. So you will need to do some analysis around it. What does that mean for your pricing? You will have to look at your price and how you price, that you may have done before. In addition to it, does that mean you need to start looking at new products? Are you fit for purpose? So what type of risks are people now looking at? In previous years, yes, there might be risk of loss of employment, but now there's things like risk of loss of, business, risks around, education for children, protecting them, risks around certain skilled workers. There might be certain things that people may not, but risk mortgage payments that may not have been taken, insurance around mortgage payments that may not have taken up as much. But now a lot of that is happening, and even life insurance now, because unfortunately, we are seeing a lot of deaths and things that happen that people might not, have seen, or even health insurance company now covering the cost of COVID, which they hadn't done because they hadn't inputted it in the past. Even when NSAS happened, I'm sure a lot of insurance companies were really affected, and things that we didn't anticipate. But we need to look at it, because as things get tougher, the likelihood of unrest is likely to increase. Earlier on, we also talked about climate change. How do you manage some of these risks? How does that affect business? How does that affect the real estate sector? How does that affect the technology sector? With increase in likely frauds and all these things. So these are a lot of things that we all need to be looking at as a result of COVID. Okay, next slide. I'm done. I've just got one more slide left. So a lot of things have been said. These are just sort of reminders for your year-end doing this. You would have done this. Don't forget to stress test your balance sheet, especially for your entities, for those of you who have subsidiaries, because it will be different for each entity. You need to look at it. Things around capital management. How do you make sure that you as a business are sustainable over the next 3 to 5 years? With the introduction of ESG, economic, social, and governance, strategies, how will that affect you? You need to sort of look at that. We already talked about the recalibration of ECL models, your expected credit loss models, and the macroeconomic realities. What are the different scenarios you're going to look at? Liquidity, what does that mean for you? Looking at valuation of non-financial assets, how will that affect you? The collateral, have you done a assessment of the collateral that you have to make sure that it's still viable? Have name change, have people, family, family members, have they been lost? Has ownership changed? What has happened? There's a lot of things that may have happened that you're not aware. So these are things that we need to take a deep dive into and look at, some of your projected budgets to sort of help make decisions. How does that affect you as an organization? These are things that you need to look at. So I'm going to stop there. One of the things that, we know and we love, and maybe not everybody loves it, is taxes. So my colleague, Timothy, is going to be sort of taking us through, some of the issues around tax, because as I said, yes, I'll talk about financial reporting. There are also tax effects as a result of some of these issues, as well as, of course, the Finance Act that has come into play as well, that we all need to be mindful. So thank you for listening, and I'm going to hand over to Timothy Saloma, who is an associate director in our tax unit. Over to you, Tim.
Good afternoon, everybody. Because of Timothy's microphone, I will take over this presentation. So my name is Kenneth Erikume. I'm a partner in the tax unit of PwC Nigeria. So, the conversation at this stage, is going to be looking at some of the things from a financial management perspective that would be considered to be important because of the outcome of the pandemic. Headline issues are that, of course, for commodity dependent countries, they've seen a decline in public revenue. And Nigeria is not insulated because our economy relies heavily, both from a forex earning perspective, as well as a public revenue perspective, relies heavily on crude oil and a bit on gas. And this has impacted on the ability of the government to meet up with its obligations. And at some point, there was so much pressure on government purse that it was becoming even difficult for the Fatca allocations to be made to states. And this pressure would definitely impact on the way the government approaches taxes. Now, one of the outcomes you would see in the Finance Act 2020 is that a lot of provisions have been included which are targeted at increasing the ability of the tax authorities to collect taxes, as well as introduce some provisions that would unlock more taxes for the government. And just to give an example in the context of the financial services industry, one of the things that has been introduced in the Finance Act, for example, is the ability of the FRS to plug electronic fiscal devices to the financial information or the financial platform or system that companies use, in relation to their sales or other things. Now, one of the things that government hopes to achieve with this, because they ran a pilot in the past with, they sort of tried pilot with the retail industry for the purpose of VAT. They approached the telecoms industry to plug those electronic fiscal devices before this law. And there was a pushback from the telcos as well as the NCC because of, obvious reasons around, confidentiality, the issue of insurgency, kidnaps, and those sort of things. They also tried to do a pilot with the sports betting industry, but there was also pushback from there because there was no law supporting it. Now, under the Finance Act, that has become law. The FRS can now plug electronic fiscal devices to the accounting systems of companies, and this would also include banks. Another thing that you could be interested in is the fact that in the Finance Act for digital services, the likes of video streaming, music streaming, platforms, marketplaces that are provided from outside Nigeria, the law now allows the tax authorities to appoint a payment services company to be an agent for the collection of the taxes that are due on such transactions. So there are many things that the government is looking at to actually, ensure that revenue, is collected. Of course, number two is that the pandemic has ushered a lot of disruptions for companies in terms of technology, and the ability to manage people and even to manage risk. And one of the critical areas of risk for many organizations is tax. The ability to meet up with the obligations, even to deal with the tax authorities virtually, and without and in a safe environment. The Finance Act also, introduces a few things around this, which, for example, the ability to correspond with the tax authorities electronically. But that's just the Finance Act. Over and above that, organizations need to, figure out how they use technology to ensure that, for their transaction taxes in particular, they keep the risk under control. Now, for this industry, the target usually of the tax authorities is on transaction taxes. And the reason for this is the high volume of transaction means that if there is a deviation or a small mistake, it could be material. And of course, the second thing is that, for many players in the industry, they have multi-jurisdictional operations because they operate in several states. So tax authorities see it as a low-hanging fruit because they can query the same financial information, several times. So state one can come for an audit, state two will come for an audit, and so on. And they put pressure on organizations that operate in this space. Of course, stamp duties is another one that the government has been looking at, in terms of a new area. The chairman of the FRS has called it the new crude oil. And the expectation of government from stamp duties is actually very high. So how companies update their systems to be able to cope with all of these things is actually very important. And I'll give you an example of some of the things you should be thinking about. And I use stamp duties as an example. Before Finance Act 2019, of course, the CBN came up with the circular saying that on transactions of 1,000 naira and above, stamp duty of 50 naira had to be paid. Now, in that CBN circular, there were exemptions for savings accounts, salaries accounts, government accounts, and so on. When Finance Act 2019 came in, Section 89 of the Stamp Duties Act was amended, which meant that all those exemptions, many of them, were taken off the table. And then Finance Act 2020 has now come in, and it has now been changed again because it now says that it's no longer a stamp duty. Well, the name has changed; it's still a stamp duty, but it's called electronic money transfer levy. But by changing the law again, the previous exemptions which were removed have now been introduced. Banks and financial institutions have to ask themselves if their systems are robust enough to monitor all these changes, as well as update their systems in an agile way to compute the taxes correctly. If you remember, early in 2020, there were a few banks that were caught out by the changes in the Finance Act, and they had to refund many of their customers stamp duties which they had assessed and collected from their customers. The third thing is, of course, government needs to diversify from oil, and they've been saying this thing for a long time, and they're looking at several areas, and government will continue to introduce regulations and laws, as well as mechanisms to ensure that the other sectors of the economy contribute. And one of the levers that they'll be leaning on is the banking and financial services industry, because it's just a low-hanging fruit from their perspective. Because from the perspective of government, where is all the money kept? It's kept in this sector. Secondly, where's all the information and data sitting? It's actually sitting in this sector. So there is no way this industry will not be targeted by the government in terms of using this industry as a basis of increasing revenue. And therefore, from your perspective, you then need to be thinking, how do I ensure that my affairs are in order and I'm properly equipped to be able to deal with, the regulations, the changes which may come up in the future. The final thing, when you look at all these three dimensions which I've spoken about, is how can you pivot your tax function and convert it from, the way a lot of people have designed their tax function in the past was in reaction to multiple audits and multiple transactions that they had to deal with. And so a lot of the tax functions in this industry that you will find when you do an X-ray and an assessment might actually be, operational and dealing with, operational and routine issues. So the big question that CFOs face in this space is how to change that outlook for the tax function and move them, from a reactive operational type function and move them to a proactive and more strategic function where they are actually adding value as against, fighting fires in relation to tax audits and filing returns and things like that. And of course, the disruption to the whole process means that technology needs to be at the back of the mind of, the CFO. How can I deploy technology to ensure that routine functions of the tax department are dealt with through technology, and then I redirect my resources into things like tax planning, tax strategy, and things that would actually add value to the business when products are being rolled out. Next slide, please. Now, the first thing that you need to think about is you determine your target operating model. Is this model which I have for my tax function the most ideal? I know I started out previously trying to deal with these sort of routine activities, but now in order to pivot to a more strategic and proactive tax function, what model would work for me? Should I recruit and in-source, all the resources sitting in-house? Should I co-source, which is, keep some functions internally and then, keep some other functions outside with tax consultants? Should I outsource, or should I go into the managed services realm? And in this day and age, a lot of companies are looking at, centers of excellence, using technology to deal with, tax management. Next, the other thing to look at is define your data requirements. In this industry, there are a lot of compliance requirements that are for the tax authorities, but the obligation has been placed on this industry. For example, things like Fatca, which was imposed by the US government on banks across the world, saying that you must give us financial account information for every US citizen that you have as a customer. Now, over and above Fatca, the common reporting standard, which is part of the whole OECD conversation around automatic exchange of information, is actually the next dimension that has been introduced, where countries other than the US have signed multilateral agreements to exchange bank financial account information between territories. So there's already a requirement which kicked in 2020 that reporting reportable financial institutions, which cover quite a number of banks and financial institutions, have to collect information of non-residents that accounts with them and share that information with the FRS. Now, the FRS is supposed to share that information automatically with any country that has signed into this multilateral agreement. And those countries are supposed to share the same information of Nigerian citizens who own bank accounts in foreign jurisdictions with the FRS. And by so doing, there's a lot of transparency and information because tax authorities are able to gain insights and information around places that previously they couldn't get, including tax havens have been signed up into this automatic exchange of information. And not only that, you also need to think about how do I deal with multiple information, multi-jurisdiction, and multiple audits. And I'll give you an example. One of the areas we see in this sector that is significantly exposed to additional assessment from tax audits is usually, transaction tax, things like withholding tax and VAT. You ask yourself the question, when the ERP systems were being set up, was tax not a consideration? Was the ability to respond to tax audits not part of the consideration? Because consistently, when different tax authorities come, multiple agencies come, there's usually additional assessment. The next thing just click is you need to also determine your technology investment. How can we automate? How can we be more effective, especially around the voluminous transactions? And many of these things can be automated. Once there is a logic to the flow, and once there is a principle to be applied, then the reality is that it can be automated. The problem we see is that many times when those investments are being made, taxes at the back burner, the finance function is to now start thinking, how can we to the conversation when we are engaging the IT department for ERP deployment and deployment. And then the final thing you need to do is to optimize your team. You need to look at whether you have the right team, you have the right skill set, you have the right organizational structure. If you are a more institution, you need to ask yourself, do I have people with the right skills to even deal with the risks in other countries that we are not familiar with? And structure. What are the areas where I am mostly exposed? Is it in the area of transfer pricing, where it's the area which I have a depth of expertise? And then we now need to round, how do we fill up those vacancies, or how to absorb in order to ensure that those gaps. Things that think about as people begin to look at classification of products with all the ratios, some of the ratios imposed by regulation. Many institutions diversification of their costs. Things like how can we deploy fintech? How go into lifestyle bank? How can we go into payment services banks? How can we play that space? But as you're thinking around that from a business, we need to think internally. Do we have the people with the right skills to move in the direction that the organization is going? So to business lead, not just the context of tax. You need to look at it in the context of business. People need to evaluate their digital attitude and customized trainings in order to upskill the workforce to be ready for the future state, because the future state is actually quite digital. In PwC, we have a digital fitness assessment mobile app, which is now available to other organizations. So if you're looking at something, to keep your staff engaged from a digital perspective, it's one of the options. Next slide. And I think that's a wrap from me. So I thank you very much. And at this stage, we will jump into the question and answer conversation. So I'll hand over to Chioma to talk about a bit around our publications and Q&A.
Thank you, Kenneth. Thanks, Timothy. Sad to see that your microphone didn't, the volume wasn't in your favor today, but thank you. And thanks again to Bolanle and Andrew for doing the COVID-19 discussion justice. So just briefly, we do have a couple of publications that are available for you. We intend to share these slides. I see the question already there, whether the slides will be shared. Of course, we'll share the slides with all the participants immediately after this event. And you have access to these webinars that we held last year, 2020, on various aspects of COVID-19. And of course, if you have any questions, you could always drop us an email. You can send me an email, and we would consider that and respond. Just to talk about the FS publication before I hand over to Kenneth for question and answer. And while I'm doing that, please do remember to drop your questions in the Q&A box. We have received a couple of questions which Kenneth would handle once I'm done. FS Focus, we do, sorry about that. We do invite comments from you. If you've read this year's FS Focus and you have any questions or you want to see any particular article in our next FS Focus publication, please drop us an email and we would, of course, follow up with you and then throw more light on that article in our publication. At this point, I would hand back to you, Kenneth, so that you take the questions and answers. Thank you.
Thank you very much. Incidentally, I think offline I've received some questions which people would like answered in relation to some of the presentations that have come through. And I would like once again to thank the presenters for quite an insightful presentation, which I think has triggered some thinking in many of the participants. Bolanle's presentation was very captivating, and questions have come in there. And one of the questions that has been raised is that, is it in all instances of loan restructuring that you recognize modification gain or loss? How would you differentiate between a restructuring that culminates in the recognition and one that results in modification gain or loss? I guess this is in the context of financial reporting and IFRS 9. So, Bolanle?
Thank you. Thank you for that, Ken. Okay, so earlier on I mentioned that you do need to do an assessment. So what you need to do is compare the cash flows from the new terms. So let's assume that maybe you had you're giving somebody 16% and they now come back and say they want 6 months moratorium and they want to reduce their rates or something to like 12% or 10%. You need to compare the future cash flows based on the new terms to the original one. and you discount it using the EIR. And if there's a difference, you compare the difference, and the difference, if it's under 10%, 10% is a threshold that is advised, even though it's, it's not set in stone, but it's the threshold that's sort of advised and the standard. If it's below some threshold, you can actually just recognize that difference in your profit or loss account, and you carry on with your instrument, the book. However, if there is a difference of that more than 10%, you will need to completely derecognize the original loan instrument, because it's now a derecognition, no longer a modification. You will then need to then record the new item. The truth about it is that you have to do the exercise. It's not just qualitative per se. Some people look at it and just assume that it's so, but you need to be able to prove it, even though in some instances you can't tell whether it's going to be a modification or the recognition. So hopefully I've answered that question for the person. Thank you, Ken.
Thank you very much, Bolande. But there's a follow-up question, so I wouldn't let you go already. So there's another question which is asking you to throw more light on the impact of loan payment holidays on significant increase in credit risk. Is there a differentiation between blanket loan payment holidays from a regulator and loan payment holidays given to obligors within a certain sector of the economy? So I don't know if you want to address that, but there's a follow-up. So maybe I should just ask the follow-up.
Okay, that's
the follow-up
fine.
is what about individual loan payment holiday requests, where the government announces that any operator in specific sectors can independently approach a bank for payment holiday? Hence, the choice is to seek for payment deferral rests within the obligor, even though it could be riding on a regulatory pronouncement. So if you can just handle that, Bolande.
Yes. Okay, thank you, Ken. Okay, so yes, here are a few things. So this has to do with significant increase in credit risk and staging. So under IFRS, you have stage 1 loans, the performing loans, stage 2 loans, and then the stage 3 non-performing loans. And what happens is that the movement between those stages is as a result of the increase in significant credit risk. Now, if a client or customer comes to you for a moratorium, it doesn't automatically mean that there is an increase in significant credit risk, and means that you move them from one stage to another. There are a few things you need to consider. Yes, the qualitative aspect. So there are other things that you need to look at. You need to look at the individual's business. Can they really afford what they're doing? The second thing is that, are you still going to be compensated for your credit risk? So if you look at the individual, so if they are asking for, let's say, moratorium of principal, and you're still being paid interest, in the long run, you're probably still being compensated for your credit risk. So it might mean that it's not really impaired. It just means that the payment, there's just a delay in payment of the principal. There is that. Another thing that you may want to look at is the sector of the individual. And another thing you also need to consider is your policy. So as an organization, what is your policy around this thing? Hopefully you haven't shoot yourself in the foot that once there is a request of monitoring, that there's a trigger on significant increase in credit risk. So that word significant is what you're looking for. When it might be an increase, but maybe not significant. So it's something that you need to look at and just make sure that you're being compensated. Now, on the government side, if it's something that's being passed on a blanket approval across the market and something that everybody's enjoying, it probably isn't a significant increase in credit risk, but you must find out where the credit risk is lying. Is the government absorbing that buffer, or is that buffer coming to you? And will you still recover it going forward? If you're still going to recover it, then it probably doesn't mean that there's a significant increase in credit risk. but it's not a blanket approval. It's something that you need to assess for all the qualitative aspects. You may need to also include a few quantitative aspects to make sure that you're still being covered for your credit difference to your credit risk, especially for the time value of money for you as well. So hopefully that answers that question. Thank you, Ken.
Thank you very much, Bolanle. I have a question directed at me in the Q&A from Timmy Topper. It says, what will you advise the CFO of a company that is setting up an ERP system to put in place, considering the fact that FRS now has access to our systems? So I think the thing is that the stage where things are now is that there is a law that allows the FRS to have access to your system. The next step will now be the actual implementation of whatever platform or system the FRS wants to connect to your system. And I think that, this is one of those areas where, you would have to collaborate with your IT unit to evaluate and ensure that the system that the FRS is going to implement will be compatible and is not going to be disruptive to business. I have experience from the pilots that the FRS implemented in the retail sector as well as in the TV sector. And I can tell you that if it is the same system that they are going to be implementing, there will be practical challenges. And some of the practical challenges included the fact that tokens sometimes are not available because the FRS server is down. And, the sort of, disruption that we expect, in things that are run from the public sector. So one of the things you need to ensure is that, it is actually fit for purpose. And if it does work for you, the way tax works is that there is always the right of the taxpayer to object. So even though this is not a tax liability, you can still take this issue through tax litigation to say, well, it's not fit for purpose. So that's an option. Now, what if it is fit for purpose? Now, if it is fit for purpose, the next thing you need to think about is the fact that, this is full transparency. The tax authorities have full knowledge of the transactions. However, sometimes the outcome of or the output from the FRS systems may not necessarily reconcile to your system. So I'll give you an example. If, for example, the FRS system has been configured to pick up every other income other than interest income and slam a 7.5% VAT on it, right? That may look right, generally in principle. However, that within those transactions, there might actually be commissions or other income earned that may be VAT exempt. So you need to put in place a structure, and it can also be automated, that reconciles the output of the FRS system to the output which is going into your tax return, so that any deviations or any differences can be effectively explained. So I would say this is a journey that you shouldn't go alone. You should work with the IT head to ensure that all the angles are dealt with. Just one more point. For example, this issue of being able to receive assessments electronically from the tax authorities, and then you object electronically to the tax authorities. The other thing you need to think about and engage the IT unit on is, how do you set up in the FRS system an email address that will, has a degree of permanence and go to the right person. So if the FRS sends you an assessment and it goes into, a person's email account within your organization, you know that people rotate and people leave. So you may actually have a valid assessment which you want to object to, but because you did not object within 30 days because it went to the wrong email address, it becomes final and conclusive. You also need to think around, within your system, some people's systems, new emails goes into spam, or, depending on the security of the email, the email platform of the sender, sometimes it sends it into spam. So those things you need to think about and, deal with them. All right. I think I've addressed that question, but, I'll go to Andrew, and, one of the things we've been seeing, across the world globally is that, the controversy around the distribution of vaccines, and, just, from reality, there are some countries that are wealthier, and of course they got access, to vaccines. I saw one chart that shows that maybe some countries in Africa will be getting it in 2023. So what can the government do in terms of looking at this issue, and is there a place for financing, for banks and financial institutions to look at how they can support the health and insurance industry in relation to not just distribution but healthcare generally?
Well, I think this issue of the vaccines is, it's a very difficult one. I mean, we all understand that wealthy countries have kind of bought up the first vaccines. I think that also, of course, even from a logistical, the Pfizer vaccine is not appropriate to Nigeria. I think people are aware that it needs to be stored at -70 until 4 days maximum, I believe 4 days before it's used. So it's just not something that we can cope with. I know that some people have given grants for us to obtain some vaccines, but not nearly the amount that are needed for our population. So I don't think there's an easy fix. I think in the general healthcare space, though, I mean, what the COVID-19 pandemic has highlighted for us is something that everyone in Nigeria knows, which is that our healthcare system is in dire straits. Now, like everything else in Nigeria, the financial services industry is kind of at the center of how to move that forward. But a lot of the financing has to be done on commercial or semi-commercial basis. I mean, the industry itself cannot, on a charitable basis, kind of replace the whole, say, primary healthcare industry. I think, but people in Nigeria spend out of their own pocket. I think 75% of healthcare spending in Nigeria is done out of pocket, out of the individual's pockets, and not covered by the government or by their insurance. It's literally pay as you go. So I think that there's a huge space for financing fixing the healthcare system, and of course it's economic. I mean, if nothing else, it's going to remove, hopefully, a portion of the people that go for medical tourism. The reported spending on that is about $1 billion a year. And the financial services industry, some of the leaders of PSHAN, so that's the Public Sector Healthcare Alliance Initiative, PSHAN, which is basically, again, the private sector trying to fix the healthcare system on that. And many of the leaders of that are from the financial services sector. So I do think that one thing the sector could do is be a little more aggressive in lending to what are viable projects for healthcare centers, for hospitals. I know there's at least one bank in Nigeria that has healthcare kind of at the center of its basic strategy. And I think they're finding a lot of success in that. I mean, like many things, we tend to think of Nigeria as poor, but I don't think that's accurate. There's a lot of money that's around Nigeria. It's a question of organizing the resources. And one of the issues in healthcare that is particularly a problem is it's not just a question of access to healthcare or even the cost. We have a more serious problem in our healthcare system, which is just the efficacy of it and really the danger. So if we have, for example, counterfeit drugs in the system, that's just, I mean, there's no words for that. But we also have healthcare providers that prescribe things that are inappropriate because the prescription of certain drugs or tests is what drives their income. So there are a lot of problems that are not necessarily just financial. It's also kind of ethical and knowledge-based. And so I think that to the extent that the Nigerian financial services industry can build up some expertise in healthcare, and so that they're financed both, and of course we have health insurance as part of the financial services industry, so that they can actually kind of help finance properly run clinical settings where people are getting good quality healthcare at an affordable price. I think that would make an enormous difference. But with respect to the vaccines, given where we are financially, our deficit position, I think we're still going to be kind of asking the world for some charitable help for some time. I guess one thing that we should be thinking about, I'm not sure there's enough thinking about, of course, is that the vaccines don't just come out of Europe or the United States. I mean, the Russians and the Chinese have done vaccines. They have very good scientists in both of those countries, and I think we should be kind of looking beyond where we normally looked and get a lower cost at. But we are going to have to accept help from the outside world to get the vulnerable population vaccinated in Nigeria. I wish there was better news, but I don't have any better news.
Yeah, thank you. Thank you very much for that insight, Andrew. I see another question from Adefunke, which is a tax question. It says companies and individuals have suffered a lot of hardship in the last year. How feasible is it to expect government budgets be funded through taxes, particularly companies' income tax, petroleum profit tax? Shouldn't the government lower its expectation for rate cuts for 2020 year of assessments and 2021? To be honest, I'm not so sure if I will be able to address this question completely. But, the government had in the past offered some palliatives from a tax perspective, which was largely related to filing moratoriums, exempt from penalties and interest, and payment moratoriums. So the government, the FRS, as well as various state revenue services actually gave some of those palliatives. But what we're seeing across Africa is that many of the tax authorities, due to pressure, obviously from the executive government, have closed and stopped those palliatives. And we saw that Kenya was one of the countries to actually stop some of the moratoriums which they gave to taxpayers. And I think it's been consistent. We've been seeing this pop up in various other countries. And the situation is one of those dilemmas that it's really a hard place for governments. It's a pure chicken and egg situation where people don't have, but government needs to find a way to fund its obligations to stimulate the economy. So it's really complicated. So it's not an easy job for government. I think that's the point I'm trying to make. However, I think the government in the Finance Act 2020, which is the new one, they sort of came up with a bit of creativity, which also has its own controversy. So there's a new fund called the Unclaimed Fund Trust Fund. And this essentially, government will be contributing 500 billion as startup fund into that fund. And the way it works is that if you have unclaimed dividends, from public companies that are sitting there and people haven't come to claim it, now it will move into that fund after a period, I think 6 years. And the same thing for unclaimed bank balances. So if you have a situation where an account has gone dormant and nobody is coming to claim the money, it then moves into this fund that has been set up for government, and it's effectively going to be a borrowing by government. So it will accrue interest, but government will then be able to use that fund, because government has maxed out taxes, except in the informal sector, but the formal sector is maxed. They've maxed out borrowings. So they had to think creatively and look at this fund. Of course, it comes with its own controversy. And one of the biggest controversies that is moving funds from the private sector, from private hands into the public sector. And people have raised the questions around the track record of government in managing those funds. And then the other thing is that it moves it from the fund which is available to be shared between the federal government and states, moves it into the to the account that is managed purely by the federal government, and so states, the allocation to states will drop because of that. So the government has tried to think creatively. They brought in some incentives, some palliatives also. So the minimum tax rate has dropped to 0.25% for a period. They've also looked at some incentives for the agricultural sector. It's a tough one for government. If it was, if we were in a better place from an economic perspective, then maybe rate cuts would have been clearly the solution, like we're seeing in Europe and more developed economies. I'll take one more question, which is relating to insurance, and it is the fact that the pandemic has led to, and this question I'll direct to Bolanle, and if Chioma has some contributions. The pandemic has led to material spike in claims and loss expenses, and the related insurance contract liability held, especially from health, travel, and supply chain segments of the sector. Can an insurer isolate the unusual pattern due to COVID-19 before making projections for the loss reserve? Bolanle.
Hi, Ken. Thank you for that. As mentioned earlier in my presentation, the objective of estimating this loss reserve is so that insurers could have sufficient reserves and they can plan for liquidity going forward. And really what happens is that insurance look at their past experiences, payouts, and projections to look at some of this historical experience. And with COVID, you can say that it's an outlier, it's an unusual period. And so usually when you have some of these outliers, you can isolate them and treat the experiences separate and exclude them from the projection analysis and your reserving process. However, one of the things that you must remember is even if you try and exclude it, the impact of COVID is a lot further along than that. As I said, some of the impact may be up to 2 years, some of them 3 years. So you can't just sort of say isolated events and then you just leave it. You have to look at the compelling evidence and make sure that you also take some type of account of it instead of just taking it as a one-off experience. So a few things that insurers should think about the lingering effects of COVID and try and do an assessment of it compared to pre-COVID days and see what that might mean for it. How long you expect the impact of COVID to linger on? As I said, it might be different for certain industries, so you need to look at that. And then you can also use the COVID period experience for future periods as well, because for all you know, maybe this might happen again. We don't know. We're hoping it won't, but you must look at it. And then look at your reserves and sort of compare it to business as usual. And maybe you might consider either you want to take a percentage difference, or you might want to increase your buffer, or look at liquidity in certain reserves for certain portfolio for clients, and then see how that in the long run will affect your reserving. So even though you can isolate it, it's not a complete isolation, because the lingering effects may be there, and it also will probably change the behavior and the way some of your counterparties and customers would appreciate or take on your insurance product. So you need to buffer for that as well. Thank you, Ken.
Thanks a lot for that. So with that, I think we come to the end of the Q&A session. If you have any other questions, please reach out to the team, and Chioma would be taking it from here and will tell you what you need to do. Thank you very much.
Thanks so much, Kenneth, and thanks again to Bolanle, Andrew, and yourself for taking in all the questions that came through. In case there are further questions that are coming from the attendees, from the participants, either from this roundtable discussion or from the FS Focus itself, if you have any further questions or you want to discuss any aspect of the FS Focus publication with us, please kindly reach out to me. My email is chioma.obaro@pwc.com. Again, chioma.obaro@pwc.com. You can also reach out to the address that you got your attendee link from. If you reply to that address with the feedback or with any comments you might have, we will take that on board as well and get back to you. And talking of feedbacks, we would appreciate your feedbacks, your criticisms, your recommendations on ways to make this even better going forward. We intend to make this FS roundtable discussion a regular occurrence to engage with you, and we welcome your suggestions of topics from your end as well that we can discuss during these sessions. Once again, I want to thank you all for being here. I appreciate all of you, and do have a lovely day and the rest of the week ahead. Thank you and good afternoon.